Welcome back to the channel. I'm Ozbourne Foreman, and today I'm going to be discussing dividend stocks, and in particular investing in them, how we can identify good dividend stocks, what risks are associated with dividend stocks, and can investing in dividend stocks be a good strategy for generating passive income. So if you like this video, definitely drop one of these, as it does help with the YouTube algorithm, and definitely ignore my elephant pillow in the background, as it's not relevant to the topic at hand. So what are dividend stocks and how do they differ from other types of stocks? I'll keep this brief because I know a lot of you watching this video may already be experienced. Dividend stocks are basically different to growth stocks because they pay out returns to shareholders in the form of a dividend. A dividend can be a cash payment, but it can also be a share payment, which gets a little bit more complicated down the line. But effectively, the business is using its cash or cash flow to therefore pay out to shareholders that hold the shares. So if you hold a dividend stock on the X dividend date, which is announced by the company, you are then eligible and will receive a dividend on the payment date. Therefore, this is how the company returns, and this is good for bigger businesses or businesses with really high cash flow that might not necessarily be able to invest all of that money back into the business efficiently. So instead, they give it in the form of dividends to shareholders. So the more important thing here is, how do you identify good dividend stocks to invest in? So what do I personally look for? I mean, overall in my portfolio, I've made about £682 in dividend income, although primarily my investment strategy is growth, and this is over a 3-year period, so on average it's been about £220 a year, roughly. But again, I'm focusing on growth stocks and not dividends, but I did start off as a dividend stock investor, and I've definitely picked up some tips and tricks along the way. First things first is a good website called dividenddata.co.uk. This is a great site because it gives you all of the dividend yields of the FTSE 100 and FTSE 250, which is all your blue chip stocks in the UK, and I think this is really useful for a beginner investor. It was so useful for me because I could go, okay, let's look at the dividend yields. Okay, I know AstraZeneca, that's a biopharmaceutical company. Oh, they've got a yield of 1.92%. Or I would look at this and go, oh, actually, this is an attractive option here. The likes of British American Tobacco has a dividend yield of 8.23%. Okay, I'm going to click and learn a bit more about it. I also know that the market capitalization is 62 billion, or 63 billion when you round it up. So I'm going, okay, it's a big business, it's a lot, it's a high dividend, and you can see the dividend yield history over time, which is probably not as useful, but it kind of indicates share price movement more than anything. You can see here down below, okay, it's an 8% dividend payer, and they pay quarterly in May, October, November, and February. More importantly, though, to identify a good dividend stock, I like to look at the dividend history. By looking at the dividend history, we can go, okay, is this company likely to continue growing their dividend? Is it going to be consistent over the longer term? In this case, we can see a steady staircase over time that accelerated from about 2006 onwards till about 2011, started to slow down a bit, and then in 2017/18, it was actually slashed, but this is probably because they changed from paying biannually in 2016 to quarterly, so overall it probably did make the difference there. Now, okay, we can see a staircase. It's not the best staircase in the world, but it's certainly growing over time, so that's fantastic news. Obviously, it didn't grow too much in the last few years, which you can see by the 5-year compound annual growth rate of the dividend of 3.4%. So that's quite low, but again, it's an 8% dividend yield, so again, this is quite a high payer already, so you're not expecting much growth on that way, but it also could mean that the share price might be quite recessed. The yield is so high. If the yield is 8% and that's your annual average return of the S&P 500, why aren't more people buying shares of British American Tobacco? What is stopping investors from buying? Because if investors buy shares of a dividend stock and they buy in great demand, the dividend yield will drop down. So typically, let's go back to the dividend yields. A company that has seen their capital or their growth of their share price grow faster than their dividend growth rate will have a low dividend yield. A good example here is the London Stock Exchange Group. You can see that over time they've had, a consistent dividend yield that's been quite low. And when we actually go, and you could imply from this, right, and you could say, well, actually, they're clearly not growing their dividend that much. Well, let's go to the dividend history. They've had a phenomenal growth rate since 2015. In fact, in the last 10 years, they've grown their dividend by, on average, 14.7% each year. If they're growing their dividend by that much, yet the yield has remained consistent over this time, it implies that the share price has increased by a large amount as well, which could be a good identification of a good dividend stock to invest in. A good example, though, further than just the dividend, would be looking at the payout ratio. So I've got Tesco here on Simply Wall Street. There's a link in the description down below if you'd like to check out Simply Wall Street. And what I'm going to do is I'm going to go down to the dividend category. Excuse me. And down in the dividend category, we'll be able to see the dividend yield, which we've seen already, but the payout ratio, which is critical here. So we can see here that an earnings payout to shareholders is 107%. This means 107% of the company's earnings is being paid out as a dividend, which is unsustainable. But when we look at it as cash on their cash flows, which I think is a more representative figure for Tesco, I think I'd look at that instead. Their Tesco's dividend is covered 32% of their cash flow is actually paid as a dividend, giving them a lot of retained cash flow that they can reinvest back into the business or they can use in the form of share buybacks. And that's really the difference here. Are you going for a company that's paying out a lot in dividends, or are you looking at a company that really pushes for share buybacks? Both are effective ways at appreciating the value of a company's shares, or at least returning value to shareholders, not necessarily pushing shares up. Again, and this is typically for the maturer businesses, the businesses that can't reinvest in themselves that efficiently and get a high rate of growth, so they look to either use buybacks or dividends. But it asks the question, are dividends actually redundant? Surely it would be more worthwhile to use buybacks. By using buybacks, you can appreciate the value of the shares because you're reducing the number of shares in the pool. Now, if you have a good enough cash flow and you're able to grow that cash flow each year, that's going to put investors willing to pay a premium for the company because they know this has got resilient cash flow and they're growing it each and every year. And then if you're reducing the number of shares in the pool, it almost creates a great growth machine here. Or alternatively, you could say, well, dividends are redundant because they're effectively wasting the money and giving it out, whereas they could instead reinvest that back into the business, even at a lower rate of growth, just to try and do better in operations. Or they could use acquisitions or mergers, these companies with these huge cash flows, let's say Tesco, for instance. Now, they could be looking to snap up some competition. Now, if you didn't know, I have a Stockwatch report, and I write up reports every single week on my Patreon. Tesco is one I've done recently, but I've also been talking about Associated British Foods and Primark, which you can see here. 13 pages of some very useful info. So if you're interested in that, definitely check out the Patreon in the link below. There is a free Mastercard Stockwatch report if you're interested in that, but there are more coming out every single week. So, what are the risks of investing in dividend stocks, and how can we mitigate them? Well, a first risk is that high yield, as we mentioned before. We can look at companies here that have a high dividend yield, and it could mean that it's going to be cut. Rio Tinto is a good example here, as they're an industrial metals and mining company. So what ends up happening is, as commodity prices increase, they're able to increase their dividend. Fantastic, they can have a high yield. But it does mean their dividend history is a little bit shaky. They sent out bumper dividends with the specials included in 2021, but in 2022 it's obviously gone down slightly because they've had an impact in cost. So they haven't been a very consistent dividend payer, hence why it's been cut. That said, it is a very high yield and could be attractive for dividend income investors. Realistically, I think a company that has a dividend orientated strategy are going to be more defensive. They're going to be brands that are quite well known, or they're going to be businesses that are less volatile as a whole, typically, because that dividend yield has value for the company, and you're going to have these investors that seek the very high yields to get advantage of them. But I think very high yields are a red flag depending on the industry. It could be an example of the idea that they've had a large sell-off recently and that the dividend could be cut soon, because dividends are not guaranteed. They're paid out from earnings, and if a business is no longer making good profits or cash flow, then the dividend is going to be one of the first things to be cut. So it's always worthwhile to be mindful of that. And you can see here on dividend data that anyone in red has been recently cut, although it's unlikely really that we would see too many great cuts here because we are following the pandemic and a lot of them have increased them since, but it is interesting to see. So a good thing, or a good way to mitigate this risk, is look at companies that have had a very long-term period of consecutive dividend growth. This way we can identify the companies that really focus on paying a dividend over the longer term. A cracking company here, for example, is Halma. Now, they are far from cheap of a company because they've been paying a dividend for 23 years plus, and I think it was closer to 40 odd, but this is where the records begin. Look at that consistent staircase without fail. During the great financial crisis of 2007 and 2008, during the pandemic of 2020, and even the dot-com bubble at the start of 2000s, this dividend has grown consistently over time. Now, it's not as high as the likes of the London Stock Exchange Group that was growing about 14.7% per year over a 10-year period, but it's nearly 7% over a 10-year period each time, which suggests some good growth. But again, the dividend yield is quite low, so you need to really balance this out. And I think this is really a way on how you can manage a portfolio of dividend stocks to ensure long-term success by paying attention to the companies that are able to keep growing their profits, their earnings, boost cash flow, and are able to keep a dividend growing over a longer period of time. I believe is a good way of identifying high quality companies. Then you can go to the next step of going, okay, this business is potentially a high quality company. They've had a really good dividend history and consistent growth. What moat do they have? How defendable is their business model? Or is competition going to erode at that moat and actually threaten their profits in the future? Now, we could go back to Tesco here. We could discuss Tesco like I was on about in my Stockwatch report. And we could argue, oh, actually, Tesco could be struggling. Tesco has a market share of 30 or 27% as of most recently. But actually, the discount retailers such as Lidl and Aldi are really eroding into that market share. So what does Tesco have in particular that makes them unique from their competition? How can they hold on to market share, whereas a lot of the full-line grocers are falling behind? Well, you could argue Tesco's innovation and recent implementation of Clubcard to really drive data and analytics could be a great way that Tesco can hold ground. You could also argue that Tesco has a vast property portfolio that they can leverage to their advantage because they have about £15 billion worth of property, and that could be worthwhile for them. What I'm saying here is that there's just more that needs to be evaluated than purely the dividend. Not just the dividend history, not just the dividend yield, but the business, the balance sheet. So we can go back to dividend, Simply Wall Street here, and we can look at the balance sheet of Tesco, for example, on Financial Health. Scroll down here. Very simple. Okay, they got 60% debt to equity ratio. They got 7.4 billion pounds in debt. Well, actually, they got a decent amount of cash, 4.1 billion, not quite the level of cash compared to the debt, but actually compared to their operating cash flow, this is impressive. Their operating cash flow is about the same as their cash level, not to be confused, obviously, which means they could pay it off in about 2 years if they wanted. That's a strong defensive and resilient balance sheet here that means that they are able to continue investing in the business, and that if tough times strike, Tesco is prepared. So really, can investing in dividend stocks be a good strategy for generating passive income? Well, if your goal is purely passive income, then yes, provided you do the work up front, you research and identify high quality companies, and you look to pay a fair price for them, then sure, I think it can be an effective strategy. But overall, I don't think it's going to give you greater returns than investing in growth stocks. And it really depends on where you are in life. If you're looking and you're in your 50s, you've got a portfolio of 7 figures, you've got $1 million in investments, and you're looking to protect the wealth of your portfolio, you don't want to be going all in on Boohoo like that Ozbourne Foreman kid on YouTube, right? Well, you're going to be looking to identify 10 to 20 high quality blue chip dividend stocks that are consistent dividend payers with wide moats so that they can not only preserve your capital, but also give you an income through your investment portfolio. And let's say you had an average yield in your portfolio of 3%. Obviously, there were far higher yields on dividend data a second ago. Well, that's £30,000 per year in passive income through that portfolio. However, let's say you're my age. I'm 23 years old. And if I'm trying to invest in stocks and shares and grow my capital over time, well, investing in dividends just isn't as advantageous for me because it's going to be harder for me to build up to that 7-figure portfolio amount. And instead, it should be better to try and increase my capital as fast as sustainably possible at the moment. So I really think it's about the differences between your investment strategy, and by sitting down and going, okay, what do I want from my portfolio? Do I need this money in the next 10, 15 years? Or alternatively, can I go, actually, I don't need to draw an income from this portfolio. I don't need to withdraw it for the next 20 years. I can invest in some higher growth stocks that might have a higher perceived risk, but because I'm willing to sit through all the storms, that I, over the longer term, will be better off because I've obviously done my due diligence correctly and I've taken on the extra risk, but it has paid off because they're not paying out a dividend and the companies are reinvesting back into themselves to grow. If you liked this video, definitely drop one of these. Don't forget to check out that Patreon. These Stockwatch reports coming out on a weekly basis, and I'm going to continue doing so indefinitely until I get miserably bored of it. And if you haven't already and you've made it all the way to the end, definitely click that subscribe button. I much appreciate it. Have a fantastic day and don't have too much fun with the coronation.